Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Minash. There's a silent partner in almost every real estate deal. You didn't invite them, and you didn't negotiate with them, and you don't control them. But they have the power to change your operating expenses, your property value, and in some cases, the entire economics of your investment. That silent partner is City Hall. Most investors spend enormous amounts of time underwriting rents, vacancy, interest rates, construction costs, and cap rates. Well, fair enough, but almost nobody underwrites the financial health of the municipality. That could be a mistake. Let's look at two cities, Chicago and Detroit. Chicago is a world-class city. It's got major employers, universities, transportation infrastructure. It's got culture, restaurants, airport hubs, and a diversified economy. It also has massive financial obligations accumulated over decades. For fiscal 2025, Chicago's pension contributions exceeded $2.8 billion. Think about what that means. Before the city decides whether to repave another road, hire more police officers, improve transit, or build another park, billions of dollars are already committed to obligations created in prior years. And those obligations are real. They're promised to real people. From the standpoint of a property owner, the question is simple. Where does the money come from? Eventually, it comes from taxpayers, fees, charges, assessments, or some combination of all of them. Suppose you own a multifamily property producing $1 million in net operating income per year. Over several years, property taxes, water, sewer, municipal fees, they all rise, let's say by $75,000. So now your NOI has fallen from $1 million to $925,000. At a 6% cap rate, that $75,000 reduction in NOI translates roughly into $1.25 million of lost property value. Nobody sent you a bill for $1.25 million. There was no line item called municipal fiscal irresponsibility, but the economic effect is still there. Now let's look at Detroit. Detroit's different because the city actually reached a point where the numbers stopped working completely. Detroit filed for bankruptcy in 2013. That wasn't caused by one bad budget. It was the result of decades of shrinking population, declining tax base, legacy pension obligations, legacy debt, deteriorating infrastructure, and promises that became harder and harder to fund. Eventually, the arithmetic won. That's the thing about municipal finance. You can defer maintenance, you can refinance debt, you could issue another bond, you could raise taxes, you might increase fees, and you might assume that future growth will solve the problem. You could make optimistic projections, but sooner or later the math will win. What's particularly interesting about Detroit is what happened next. The city emerged from bankruptcy and has spent more than a decade rebuilding its financial position. Its credit ratings have improved materially. Governance improved. Budget discipline improved. Investment returned. The story today is substantially different from the story in 2013, but even after the bankruptcy, the past does not completely disappear. Detroit's budget this year still included a legacy pension payment of about $173 million. That obligation was created years ago. Some of the people paying for it today had nothing to do with the decisions that created it. That's one of the fundamental problems with municipal finance. The political horizon might be 4 years, but a municipal bond might last 30 years. A water system could last 60 years. A pension obligation can last even longer. Many people making the decision today may be long gone when the largest bills arrive. And there's another issue that gets even less attention. When a municipality builds something with borrowed money, it creates two liabilities. The first is obvious. That's the debt service. The second is the operating costs. So imagine you build a recreation center, and now you've got employees, electricity, insurance, cleaning, maintenance, and repairs, in addition to the debt service. You build a road, and now you've got resurfacing, snow removal, and replacement. You build a water system, and eventually pumps, pipes, and treatment equipment wear out. The ribbon cutting ceremony happens once. The operating expense happens every year. And this is where capital spending quietly turns into future taxation. This matters especially in fast-growing cities. Growth can hide financial problems for a long time. A city can issue bonds, they can build infrastructure, they can expand services, and assume that future development will enlarge the tax base enough to carry everything. And sometimes that works beautifully, but then sometimes it doesn't. If growth slows down, the debt doesn't slow with it. If property values fall, the infrastructure still needs maintenance. If construction stops, the city slows payroll. So when I look at a real estate market today, I want to know more than just is the population growing. I want to know what's happening inside City Hall. How much debt does the city carry? How well funded are the pensions? What percentage of the recurring revenue is already committed to debt service? how much deferred maintenance exists, what major capital projects are coming, and most importantly, who's going to pay for it all. Because there's no such thing as free infrastructure. Yeah, the developer pays, the homeowner pays, the tenant pays, the business owner pays, or the property investor pays. Usually it's a combination of all of them. So next time you're underwriting an apartment building, industrial property, or development site, spend a few minutes underwriting the municipality. City Hall might never appear on your partnership agreement, but make no mistake, they're already in the deal. As you think about that, have an awesome rest of your day. Go make some great things happen, and we'll talk to you again tomorrow.